Frank, thanks for joining me on the podcast today. Excited to get into it.
Well, thank you. Thanks for having me.
Yeah, I think our topic is interesting today. We come across it a lot in our business when we work with a lot of retirees, pre-retirees, and they're considering their investment options, whether they go with someone like us and they're looking at a balanced portfolio, something that's going to grow in the market over time. But a lot of what pre-retirees and retirees get pitched are annuities. And so today I really want to break down some of the costs, really the pitfalls of these products, because I think we should just call them products because they are really sold heavily to these individuals. And I want to inform our audience, these people specifically, about, hey, what to watch out for, the problems that they might encounter when or if they potentially invest in these things.
Well, certainly. There's a lot of things that people don't realize. They get pitched annuities because of the safety, the guarantees. I liken them in some ways to a mayonnaise jar, which is very safe, and there's a guarantee. The guarantee is you're not going to make any money, not going to lose any money, but and that may be not completely fair because annuities, you can make some money, but it's typically the way they're structured and the amount of fees and upfront commissions that come out of them. It's just not possible, especially in lower interest rate environments. And even though we've gotten used to thinking 5% is a high rate, it's for an insurance company trying to make a good product, a good annuity, 5% is a very low rate. They have to overcome the first hurdle is the 10% commissions that are on most annuities. The ones that people are going to hear about are the ones, the indexed annuities, the fixed rate annuities. They're going to have the higher, especially the indexed annuities that are on the S&P 500, or sometimes they're on a made-up index that nobody's ever heard of.
Yeah, and I think that kind of gets into the gist of the conversation for individuals who, one, I want to make it clear that throughout this podcast, we're going to talk about, one, the pitfalls, then two, the alternatives, things that, we would suggest as an alternative to annuities. But then three, if you're listening right now and you are already in a lot of these products, don't necessarily freak out. There can be ways to either get out of them or shift positioning to have a better portfolio. But can you kind of quickly define, for those who may be less familiar, what an annuity is, the kind of a couple of the common types, just so to kind of level set for our audience who may be more or less familiar just hearing about these products because someone called them on the phone talking about them for the first time?
Certainly. Well, the easiest, most straightforward one is just the fixed interest rate annuity. You can get them in various forms. Sometimes it's a guaranteed rate for 3 years, 5 years, 7 years, and you know what the rate is, and it's going to stay there. Typically, I guess I would favor those over the rest because at least you know what you're getting. The more common fixed rate annuity might start off with a little bit higher interest rate, and you're typically going to be locked into it for 7 or 10 years. And they have a minimum guaranteed interest rate. And though the insurance companies very often are paying the first year rate, the one that's being advertised, is actually higher in many, if not most instances. It's higher than what they can really afford because they got to take your money, they got to pay the commissions, they've got their own overhead associated with the product, and just the expenses that they've got to overcome from having developed the product. There's many layers. So they might offer 7%, and sounds great, but if the guaranteed minimum is 1.5%, well, they can't pay 7% in this environment. So you get the 7% the first year, and then it renews, and maybe it's at 4%. But lo and behold, they're still offering brand new money 7%, but they've renewed you second year at 4, 4.5, then it comes to 4, and if interest rates start coming down, the amount you're being paid comes down quickly with them. because obviously they're only able to invest your money because they need to invest your money, pay you an interest rate, and make some money themselves and recoup the commissions and expenses that they had up front. So, and just the opposite happens when interest rates start rising. If interest rates fall in the first few years and you're down to getting 3%, and then all of a sudden the interest rates start to rise, you'd think that your payments start to rise too, but that happens never or seldom. The interest rates can go to 4 and 5 and 6, and you're still sitting here at 3. Sometimes I've even seen it where interest rates rose and your renewal actually dropped to 2.5, or something lower than what you just had.
Right.
So that's the most common, most straightforward of the annuities. The most common one that's sold is called the equity indexed annuity. It's typically based on the S&P 500. Sometimes it's on a made-up index. They come up with this, some name you've never heard of, and even Perplexity can't find it. But it'll be based on let's just use the S&P 500 for instance. Well, if the interest rates, there was a time back in the late 90s when these things first got popular that the interest rates were high enough. Interest rates were 9 and 10%. And the way that annuity works is they take, say you have $100,000. It costs them 10% commissions between the salesman who gets 7 or 8 and the marketing firm that they're going through that gets the rest of the 10. So there's 10 that goes down. Of course, the insurance company has a couple of percent of expenses too. So basically, your $100,000 really to the insurance company is $88,000 that they can do something with. Well, if interest rates are 10% on that $88,000, that gives them $8,800 to go out and buy call options on the S&P 500. Well, they can buy enough of them that maybe they can offer you, because if the S&P goes up 12%, you'll get the full 12. If it goes up 25, you'll just get the 12. You'll be capped. And so that's clear. But they say, if the S&P goes down, well, then the call options just expire worthless and you don't lose any money. So your money just stays the same. Next year, they take the interest off of your $88,000. They buy call options again, and it works. You can get enough call options when the interest rates are high. But you have that interest rate now down at 5% and 4%. Well, now you're not buying $8,800 worth of call options. You're buying $4,400 or less of call options. And now to get you a return on your $100,000, maybe they can only get you 6% instead of 10 or 12.
Right.
And so you're looking day one at something that you're seeing an illustration, and maybe the person says, well, we've got a 12% cap on it right now, but let's just run this at 8.5% or 9% or something per year. And so you're looking at these big numbers, and it's guaranteed no losses. Any bad year, you don't lose money. You only go up. Okay, I can accept the cap because I'm okay getting 10 or 12. I'm being conservative here. I want the guarantees. And but typically that's exactly what happens. Especially in a low interest rate environment, there's just not enough money for them to overcome all their expenses, make their annual profit, and buy you enough options. As a matter of fact, I've seen many of them go down to, recently here, 3.5% guarantee. So if the S&P goes up 3.5, you get 3.5. If it goes up 5, you get 3.5. If it goes up 25, you get 3.5. If it goes down, you don't lose anything.
Right.
Well, to get 3.5, that's not a high hurdle in other things that are very, very safe.
Yeah. And I think you touched on a couple of important things there. One, you kind of briefly mentioned it, but the high fees and commissions that are associated with these products. Obviously, the salesmen make a lot of money from the insurance companies pitching these products, selling these products to individuals. Those commissions can be anywhere, 6 to 10% on a lot of these. And that's really coming out of the investor's wallet, because if they're going to put up $100,000 for an annuity, that 6 to 10% is coming out of that, even though on paper the insurance company or the provider is going to show $100,000 investment. They're just going to have to kind of recoup that over time while still charging continual management fees and other things on top of that. And then the second part that I think was very clear by your explanation is that these are very complex products. I think a lot of times they get pitched as simple, say, your principal's protected, you're going to have this kind of growth. But once you get into the fine print, it's really much more complex than that. They're using complex financial products on top of it in order to, provide these returns. And they're changing, like you said, the caps on your return in the annuity over time, which is creating, more complexity, not a very favorable investor experience. Sure, you can say, okay, my money's, going to be there in that fixed index annuity, but you don't actually know that you're going to get the kind of growth that they may pitch you up front. And so I think that's where, if you're talking about where do you want to put your money as an investor whenever you're going into pre-retirement, post-retirement, do you want to deal with a lot of that complexity? Are you willing to read through the fine print of the annuity contract that you're about to sign a huge chunk of your wealth over to? And I think it really gets to the point, and this wouldn't be the complexity wouldn't be a problem, but it kind of leads us to our next pitfall of annuities, is the lack of liquidity. And there isn't a lot of liquidity in these products, and maybe you want to kind of touch on that, but it's a lot of investors, once they're into these annuity products, have a really hard time getting their money back out.
Well, they do. And another thing, now there is one element of liquidity that they have that's typical in most annuities, is that you have the ability to take a 10% free withdrawal. In other words, no surrender charge, because the surrender charges in these things are high. They're going to start off first year. If you want your money back out after 1 year, you're paying 10%. You lose 10%. Well, they got to charge you that because they paid out 10%. And they only had your money 1 year, so they probably got their 2% of cost and a little profit off of your money, but so 10% it goes out. Usually the second and third year, 10% too, maybe even the fourth or fifth, and then it starts ratcheting down, and people need to realize, okay, so you do have that element of liquidity, but here's another downside of it. So your money's in there for a year, and you decide you want some out. Well, whatever gains were made that year, those come out first, and they come out as income. So it's taxed at income tax brackets. That's the thing about annuities, is that no matter when you take the money out, it will come out first as totally income tax. It's all the gains. So there is no long-term capital gains treatment in annuities.
And I think that's probably, a big core of the conversation here is the tax implications of annuities, is because, yes, you're getting that deferred tax liability. And some people are attracted to the fact that, I don't have to pay taxes on it for X number of years until I start making withdrawals. But if we're going to compare that to a balanced investment portfolio, there's a big difference. Sure, if you're talking about dollars within an IRA, if you're going to invest in the stock market, an IRA, deferred tax liability, you're going to pay the taxes when you pull that money out. In an annuity, you're going to pay the taxes when that money comes out. But as far as if you're talking about after-tax dollars that you're investing, well, all of a sudden, if you're invested in the stock market in a balanced portfolio that's going to grow over time, you're not going to touch that money the same as you would be if you're putting it into an annuity. Well, in the stock market, to your point, you're getting long-term capital gains. Versus an annuity, you're paying income tax rates even if it's down the line. So I think that's something important for people to consider.
And most people don't appreciate the amount of tax deferral you get in an investment portfolio, because we can look at, just take Microsoft or Nvidia, something like that, something that we've owned for years and years and have huge gains in, but we're not paying any tax on it. It's still tax deferred. We paid a couple of dollars a share for Nvidia, and now it's $170. But when we do take some out, we get to take it out on our terms, And we can also offset it if there's some losses in the portfolio. So, the taxation on a taxable investment portfolio is much, much better than people give it credit, and much, much better than when they're showing you a comparison selling you an annuity. I'll go back to just briefly to the commissions thing, because I've heard many people say, oh no, the salesman told me that it's not coming out of my money, that my $100,000 is still show up. I've got $100,000 in there. I said, well, yeah, on paper you do, but to act like the commission's not coming out of your money, the insurance company's not going to pay that person one dime if they don't bring your money to the table.
Right.
So whose money is that 10% coming out? That $10,000 isn't coming out. They're not getting paid anything. And the other thing, too, that just logically, if you're over age 60, you probably get, like I do, in the mail on a very regular basis, an offer to go to Ruth Chris Steakhouse or some other real nice steakhouse or real nice restaurant and get a free steak dinner or a free lobster dinner. Well, if the annuities weren't that profitable, that the salespeople will spend $15,000 on a seminar. They'll send it out and they'll have 2 different dates, 2 different dinners on one expensive polished mail out, and they're spending $15,000 or more dollars. Well, okay, but keep in mind it only takes $200,000 to bring in $15,000 or $14,000 to $16,000 of commissions. So that's pretty easy. That's not a high hurdle to convince a bunch of people that came in and they're hearing this great pitch, this polished pitch.
Right.
So keep in mind, the only place that money's come from is your pocket, and I don't think that it makes a lot of sense with any investment to have the person you're working with, your advisor, where they make a lot of money if you do this and almost no money if you do this, or they make very little if you do this and a whole lot if you do this. What are you going to hear about? You're going to hear about this, and that's why everyone is familiar with the equity indexed annuities.
Right. And I think that's why, we are so focused on, when we work with our clients, expressing that we're not charging commissions, we're not selling products, we don't get paid more if we put you in one thing versus another, and we're a financial fiduciary, which means we have to take the client's best interest whenever we're making those investment decisions. We have a legal obligation to do that. And I think that's important for a lot of people to know. The annuity sales people typically do not have that fiduciary obligation, and it's a one-time sale a lot of times up front, generates that big commission. Whenever you're working with a financial advisor, a financial planner, there's someone who's invested in you along the way, because that's a continuous relationship. And I think that's kind of where we're going to get into in just a couple minutes on the alternatives to annuities whenever you're talking about securing retirement. The last thing I want to touch on as far as difficulties with annuities is the passing on of these assets to beneficiaries down the road, because whenever you have a traditional investment account, well, if you pass away with assets still in there, you've got stocks, bonds, alternative investments, you're getting that step up in cost basis for your beneficiaries, whether that's children, grandchildren, a charity that you're fond of, whereas it can be very different in annuities. A lot of times that money won't even be passed on to beneficiaries, and I think that's something critical to know as well.
And that kind of brings up to why there's become so many riders on these annuities, because the riders, they have the guaranteed income rider is the most popular one, but they have all sorts of riders, long-term care rider. They have this rider, that rider. You're already paying high fees inside the annuity. And then you start adding riders at 1.5%. That means your real money, the money that you can really take out in the future, is getting reduced and reduced, because if you're limited to getting the first 6% of the S&P 500, but you got 2.5% of riders in there, Well, now you're at 3.5% is the maximum you can get in a year. And they'll show you and they'll say, well, but we got a 7% or 8% guarantee for 10 years on the income bucket. They call it a bucket because it's not real money, it's a ledger. And it's the ledger of which you can annuitize. If you wait 10 years, you can annuitize that. In other words, take a lifetime income from that amount of money. So if you start with $100,000 and 10 years later it's showing up as $200,000, but your real money is over here showing up at 112. So if you take out the 112, the good news is you're only paying income tax on 12, and you get your cost basis back, but you made 12,000 in the 10 years, whatever the number is. But the $200,000, it's almost it's just like I want to call it the same as Bernie Madoff, but Bernie Madoff would adjust a ledger because it wasn't real money. He was just doing a spreadsheet for his clients. And if they complained about only making 9.5%, well, then all he had to do is go into the spreadsheet and go, well, hey, again, we've worked, look how good we did this year. This year we made 11%, it's a ledger. And they say, okay, you got $200,000 in the income bucket, but to get that, now you're already 10 years older, so you're 65 when you buy it, say, and you turn 75. Now you can start taking this great, 7 or 8% per year guarantee. Well, the thing that you are missing there is the fact that I can make it, instead of $200,000, I can design one that gives you $300,000. But if all I do is say the annuitization rate at 75 is 1%, well, then you get $3,000 a year for life. If I give it 2%, you get $6,000. Well, it's the same with them. They can just dial it back to whatever is reasonable. Now, you might be able to take $200,000 out into the market. If you had $200,000 in cash, you might be able to go out in the market and bid insurance companies and say, I want an immediate annuity that starts, pays me for the rest of my life. And at 75, well, you might be able to get one that pays you, 10 or 12% per year, because they know that half the 75-year-olds at age 86 will be gone. They will have died. So they're looking at the mortality tables, and they say, oh, yeah, well, I can easily give you 10%, because
Right.
that means that you're not getting that 200,000 out, at 10%, you're getting 20,000 a year. It takes you 10 more years. You're 85 before you've gotten your money out with no growth.
Yep.
Well, that's the same thing that's happening in the product, except that they have your money. And if you want to go bid it, well, all you got is the 112 or the 120, whatever it grew to after the fees. The 200,000 is only if you're with that company. And so if they say 4.5% at age 75, well, then you're getting your $9,000 a year. And it takes you, even if they say 5%, that's $10,000 a year, but you've started 10 years later, and it's going to take you 10 years just to get your initial $100,000 that you paid in.
Right.
So 20 years out, you've gotten just your money back out. You're 85 years old at that point. So are you ever making any money? It's kind of a silly.
Yeah.
If you do the math on it, it's sad.
And I think that's a perfect time to transition and talk about alternatives to those annuities, because a lot of people get sold on that idea that, hey, my principal is safe, I'm secure, I don't have to worry about a downturn in the market or something like that. And I think the beautiful thing is that in our job, for clients who are super conservative, today there's more options than ever as far as investments that we can, place people into that will protect their principal, provide upside return, just provide a very conservative portfolio for individuals who are concerned about downturns, where their money's liquid, it's tax preferable, and they can actually get some growth out of it rather than being stuck in a product that they may not be so happy with, a few years down the road, or situations change all of a sudden, maybe they're sick, or maybe their life expectancy is shorter or longer, or they have a, difference in opinion of how they want to treat their beneficiaries. You have much more flexibility when you're getting into a diversified investment portfolio with an advisor who can help you along the way. And so getting into some of those options, I think, now we have structured notes that can provide extremely good downside protection with upside participation or regular payments, if that's something that you're concerned with. We've got defined parameters and buffered ETFs that provide, market exposure up to a cap with downside protection. And those are liquid versus your annuity that, may be promising that, but, you've got more transparency here, better liquidity.
And better taxation.
And I think, that's the core of a lot of it. Like you said, is that having long-term capital gains, being able to pull the money whenever you want to at preferable tax rates is a very, very attractive piece of that people need to consider.
Absolutely. As a matter of fact, today within a structured note, we can essentially do exactly what the insurance company is trying to do in their index annuity. We can make a structured note, and it's based on the S&P 500, and or something or some other. We have lots of options, but we can structure it to where it makes 8 or 9% per year and has zero downside. So market does poorly, just like in the annuity, market does poorly, you don't lose anything that year. But what we're doing is we can basically do the same structure, or basically the same structure that the insurance company is trying to do, but we do it without the 10% of commissions up front. We do it without the 2%, 2.5%, 3% that the insurance company wants to make each year. We do it without all these riders. You have full liquidity. There's no surrender charge. So you can have all the good parts of the equity index annuity without the bad parts. And we can design it either to where it's just taxable income like you get from a bond, but you're getting it at a much higher rate and very secure investment. But anyway, or we can design it to where it goes 12 or 13 months and your money comes to you. Instead of getting it monthly in the form of interest, you get it at the end, and it's long-term capital gains taxed. So you pay half the tax.
Right. And that's where I think things like that. We've got other opportunities on the very, very conservative side of the spectrum. But I think weaving those into a diversified portfolio for individuals who are willing to take at least some risk, you can still invest in high quality stocks that are going to get those long-term capital gains when you finally decide to sell out. You can invest in high quality fixed income. You can invest in preferred shares. You have a lot of options of investments that can give you the opportunity to generate nice returns, whether that's money that you want to spend on yourself or leave to your beneficiaries, while maintaining a very conservative approach to investing. It doesn't have to be, the throttle doesn't have to be all the way forward or all the way back. If you consider it all the way back with an annuity, well, you can at least throttle up a little bit in order to give yourself some return. Or like we said, we just mentioned those things that are on the same side of that spectrum as the annuity, very, very conservative, providing you a very modest return with the benefit of long-term capital gains, with the benefit of added liquidity. And so you have more flexibility there, which I think is the benefit. And I think it's always worth investigating that before tying your capital up in a product that isn't going to allow you to pull it right back. The good thing about someone who works with us, if for whatever reason, if they weren't happy after a year, well, their money is liquid, they can take it wherever they want. But we think that by putting individuals into a diversified conservative basket of high quality assets, they're going to be happy that they did so, and it's going to benefit them over the long run.
Oh, of course, I agree with all of that, and that's why we've structured our business the way we've structured it. But the other thing that we can do even to emphasize more on the short term, the safety, is that, well, one, we could go back and design structure notes that do, like I was saying, and it may be what we consider modest returns, but they're almost certainly higher returns than you're going to get in the annuity because we eliminated all those fees and expenses, and you have the liquidity. But the other thing too is that if for someone who's and I think this makes perfect sense. You're retired. It makes sense to go ahead. Let's take 6 months, 9 months, even a year's worth of expenses, and set them in something that's just going to get you, today 4% or something. That's just sitting there to the side. So if you're in the market with some of your money, then if that takes a dip for a little while, you have time for it to come back. You're not trying to take. I advise against someone who's taking regular income to be fully invested in an aggressive position in the market without having that. Now, if you have that safety net, well, you can draw from it during times that the market has a sell-off. And it's just like we experienced a few months ago when the tariff announcement and the famous Liberation Day, that, the market sold off, but then you pull from this reserve cash because it's not going down, and then the market turns around, comes right back up. And so whether it's as fast as that or it takes a year, you're not selling shares at lower and lower prices and having to sell more and more shares. So there's lots of things to do to mitigate, the risk.
Right. And you made a great point. Cash right now, it's yielding right around 4%. So you're not in the worst case scenario. Of course, we expect rates to kind of trickle down over the next couple of years. But right now, cash isn't a terrible place to be if you are very concerned, if you are taking regular distributions. So you're not sacrificing too much by having some of your capital on the sidelines.
Well, and if those rates do come down like we expect, that will make the annuity, whether you have it already or you're thinking of buying it, it will make it start pay less and less and less until it gets down to that guaranteed minimum. And the guaranteed minimum typically is 1 or 1.5% per year. So, it's buyer beware.
Right.
Oh, one thing too I think we ought to say is that, there are ways to strategically get out of the annuities too without just having to wait for the surrender charges just to completely disappear. Because realistically, you pay the surrender charge the day you accept the annuity contract, because you're paying it either by leaving early and paying the surrender charge that you see, or you're taking, for this exact same investment, you're taking less return every year because they have to recoup those upfront fees and expenses. So, but there are ways to smartly get out of one.
Yeah, that was going to be my last, kind of closing point, was that for anybody who is currently invested in annuities who, maybe they listen to this podcast or they had a bad experience and think they may have made a mistake. Well, there's still opportunities to transition out of those. As you said, it's worth consulting with, a financial advisor like ourselves who can, look through the annuity contract and say, this is what your surrender charge might look like at this period in time. Maybe it makes sense to do it this year or next year, depending on where you're at in the timeline, and get yourself into a flexible investment portfolio that is going to provide you a, more attractive growth profile, better liquidity, all these things that we've been talking about throughout the podcast. It's not the end of the world if, you've already placed, some of your capital in these things. So there's opportunities to evaluate your options, going forward.
Certainly. And final thing is the benefit of having a more diversified portfolio too is that there's very little opportunity in CDs or annuities or something like that, even in most bond portfolios these days, to pay your taxes and come out ahead of inflation. I mean, real inflation. Even if our inflation rate that the government monitors that we're looking at is 2% or a little over, I find that most people's inflation rate that they're really enduring is a little higher than it's ever stated anyway. And so I always consider annuities and CDs a safe way to go broke slowly. Because if you're getting that same payment year after year after year and inflation's eating away at it, well, keeping in mind, 10 or 15 years down the road, you're really living on about half as much money as you started off with.
Right.
So.
Well, I think we did a pretty good job covering everything today. The pitfalls of annuities, why individuals should be very cautious if they're looking to get into these investment vehicles. But the fact that there are great alternatives that are very conservative, principal protected, things that we help our clients with all the time. And then finally, if you're in an annuity, feel like you're stuck in an annuity, there's options to evaluate that. It's worth working with somebody to kind of evaluate your options. So, Frank, thanks for your time today, your wealth of knowledge on this topic, and I appreciate it.
Thank you. Enjoyed it.